soon. All right. Well, wonderful. Thank you. Thank you. Thank you. So I guess we are ready to start. So it's not every day that one gets to the honor to introduce not one, but two truly great scholars who are shaping the foundation of our finance. And I am that lucky person today. So having introduced Lars Hansen, and now I get the chance to introduce Darrell Duffie. We are very grateful that our next speaker has accepted our invitation to present a highly relevant work at this conference. Darrell Duffie is Adams Distinguished Professor of Management and Professor of Finance at the Stanford Graduate School of Business. He is a fellow and a member of the Council of Econometric Society, a research fellow of the National Bureau of Economic Research, and a fellow of the American Academy of Arts and Sciences. Professor Duffie was, of course, the 2019 president of the American Finance Association, and in 2014, he chaired the Market Participants Group charged by the Financial Stability Board recommending reforms to the interest rate benchmarks. And I think his talk today probably is a culmination of that work. Professor Duffie's research interests include over-the-counter markets, banking, financial stability, credit risk, valuation and hedging of derivative securities, financial market structure, term structure, and financial innovation. Darrell Duffie is recipient of numerous awards and distinctions, including the Amundi Pioneer Prize by the Journal of Finance, Financial Engineer of the Year by the International Association of Financial Engineering, and NYC Prize for Research by the Western Finance Association. We are very lucky to have him here today, and the title of his work is Still the World's Safe Haven, Redesigning the Treasury Market After COVID-19 Crisis. So it's all yours, and you can share your screen, Darrell. Thank you. Welcome.
Thank you. Thank you so much. It's a great pleasure to be here. Hossein, your introduction was too generous. This is a wonderful opportunity to talk about this work. I confess I'm joining a couple minutes late because I missed the start time. I had it marked wrong in my calendar, but I'm all set.
You were exactly on time.
Good. Well, what I want to talk about, first, can you verify that you can see this slide?
Yes, we can. Yes, we can.
I'm going to go to full screen. What I want to talk about, and Hossein, can you tell me when I have like 5 or 10 minutes left?
Sure, no problem.
I want to talk about what happened in March in US Treasury markets and actually global government securities markets and what it tells us about market structure, about the actually rather ineffective market structure that we have for bond markets, and the importance of that for the US Treasury market, given it's supposedly the safe haven of global capital markets, a major source of price discovery for all markets. We use the Treasury yield curve extensively throughout the world for pricing. And it's an anchor for the reserve currency status of the dollar. And what happened in March, which I'm going to describe, called into question that status of the US Treasury market as a bulwark of financial stability and price discovery. I want to also suggest not only a diagnosis of what happened, but also possibly a way forward to a more effective market structure. And I'm looking forward to any questions or comments or suggestions. I'm trusting that Hossein is watching the chat function and will interrupt me if I'm not clear or if someone wants to interject or to ask questions when I'm finished.
Sure. Thank you.
Thank you so much, Hossein. And let me thank Sanjay and you and all of the organizers of this meeting. And appearing in the same meeting with Lars is always a pleasure because I get to learn from him too. So in March 2020, the news of the COVID pandemic hit financial markets very hard. equity markets plummeted. And as usual in a in an extreme stress on pandemic news, investors flooded the market with demands to trade treasuries. There was what's widely considered a dash for cash. In fact, there were a huge amount of requests to liquidate treasury positions in order to get cash or to get out of long duration positions that exposed investors to risk. Now, what normally happens in this situation is that the yields on treasuries drop as they did in 2008, and the treasury market continues to function well, supplying liquidity as demanded and acting as a safe haven. That did not happen. Treasury yields became very volatile. And in fact, instead of going down, they went up and down dramatically in mid-March. For example, on 2 days in March, if you had owned a 30-year US Treasury, over those 2 days, you would have lost 10% of the market value of your position. Now, of course, if that was because there was an assumption that this crisis meant that the Treasury could no longer pay down its debt, well, that would be one thing, but that wasn't the issue. The issue was the market simply stopped being able to intermediate the demand for liquidity. Most of the bond trades by investors in this market are handled by very large bank-affiliated dealers. And because of post-GFC capital regulation, the balance sheets of those dealers were heavily constrained from absorbing those giant flows from investors. And please don't let anything I'm going to say suggest that we should back away from those capital regulations. To the contrary, they have been extremely important, and I'm not going to propose that, although some have. The bond market choked on those huge investor demands, and the only resort left to the central banks was to buy up an enormous amount of government securities in order to reduce the amount of securities that those large bank dealers had to handle. So for the Fed, for example, just in the 3 weeks following that mid-March collapse of functionality in the Treasury market, just in 3 weeks, the Fed bought $1 trillion of US Treasuries and entered a program by which it committed to buy $3.2 trillion of treasuries this year, or 15% of GDP. Now that's unprecedented. That's the largest market action in all time by any central bank by far. The European Central Bank faced similar problems, as did the Bank of England, and they entered into pandemic purchase programs that were on the same order of magnitude relative to GDP. Although they were not quite as quick as the Fed, they were also very effective in eventually returning their government securities markets to liquidity. Initially, I thought, well, perhaps the Fed is very concerned about rising Treasury yields, and it's basically doing some form of quantitative easing, or basically controlling the prices of treasuries. But that's not what Chairman Powell said they were doing. He said they were and as I've looked into this, that seems to be what they were trying to do and eventually did accomplish. My concern, however, is that if we rely on central banks to come in to rescue the Treasury market in the future, there's going to be a significant amount of moral hazard, because as I'm going to suggest, the amount of treasuries is getting way too big relative to the ability of the market to intermediate it. Let me explain what I mean. This is a diagram of the quantity of purchases of treasuries by the Fed in the weeks. This is a week by week, and you can see in the first 3 weeks, they were buying hundreds of billions of dollars a week. This is the current market structure market, which is typical of our over-the-counter markets today. It's a two-tiered market, core, periphery. The blue dots here are investors. The green dots are the major dealers, the largest of which are bank affiliated, so subject to bank regulations. When a customer wants to liquidate a treasury or to buy a treasury, the customer is invariably working with a dealer, either bilaterally or through a multilateral trading platform. Once the dealer takes those treasuries, they can be sold on to another customer or to a dealer in the interdealer market. The dealers have a central limit order book market in which they can also lay off positions. And that is in the US, the predominant interdealer broker market is run by BrokerTech, which handles the vast majority of trade of on-the-run securities in the interdealer market. So with this two-tiered structure, a customer of a dealer must trade through a dealer, cannot trade with another customer of a dealer. So there's no all-to-all trade in this market. The only non-dealers participating in the central limit order book market are specialty firms called principal trading firms that are essentially high frequency trading firms supplying liquidity and taking liquidity in the interdealer market. That market structure is responsible for the problems in March. And I'm going to come back to that issue. The dealers' balance sheets were simply not big enough to absorb the flows coming from all the blue dots around the world. Let me try to go into more depth on that. And again, Hossein, please interrupt me if you get a question for clarification.
Sure, no problem. I'm keeping an eye on Q&A. Yes.
Good, thank you so much. So it'll take a minute or two to unpack this chart. So please, everyone, bear with me. On the horizontal axis is the timeline from 1998 to 2025. The vertical axis measures quantities in trillions of US dollars. There are two time series. First, I'll do the red. So in red, we have the total balance sheet of the largest US bank holding companies. And you can see these are the household names that are listed in the footnote. And there's, I'm going to use my cursor to show you the obvious pre-financial crisis trend by which these balance sheets were growing exponentially fast. Between 1998 and 2008, they tripled in size. Why is that? Well, because capital regulation was very light at that time. And at the same time, these banks were considered too big to fail, which meant creditors would lend to these giant banks at cheap interest rates. This was kind of jet fuel for their balance sheets. They expanded their balance sheets rapidly because they could buy assets and fund them at very low borrowing costs. Everyone knows when the financial crisis hit, that ended. The official sector put in place two major changes in the regulatory environment. First, they pushed back on too big to fail. First, by allowing Lehman to fail, and secondly, by putting in place mechanisms by which they plan to resolve the failure of one of these very large financial institutions. Creditors got the message. Creditors now charge these banks much more per unit well, they charge much higher yields for the same balance sheets. And that's reduced the incentive of these banks to grow their balance sheets with cheap debt financing. The second major change in the regulatory environment was stronger capital requirements. And one can debate whether they're strong enough or not, but they definitely served to limit the growth of these balance sheets. And it's very clear the red bars are not growing very fast after the financial crisis. Now let's turn to the blue bars. This is the stock of Treasury securities outstanding. And you can see that, and by the way, there's no particular reason they should be bigger or smaller than the red bars, but you can see in terms of the trends, the blue bars were below the red bars and growing more slowly than the red bars before the financial crisis. After the red bars, that's opposite. The blue bars are growing much more rapidly because of very large US federal deficits. And they're projected to grow yet more rapidly because of the COVID crisis. In 2020 alone, US Treasury security debt is expected to grow by $3 trillion. And the budgets are also very, the budget deficits are very big after that. So this is an unsustainable trend. If in March of this year, in 2020, the amount of treasury securities to be intermediated by the bank dealers was too big on COVID news, then certainly the next time that there's a major disruption in financial markets with a much larger stock of treasuries that will be liquidated, the dealers are going to be overwhelmed. Here's the, I'm going to skip this slide in the interest of time because I don't want to get into too many details. Here's a picture of where the stress is coming from. One source of demand for liquidity is sales by foreign investors in US Treasuries. On the horizontal axis of this diagram is foreign gross sales of US Treasuries in trillions of dollars. This is a histogram, and you can see that in terms of frequencies of months with a given amount of sales since the year 2000, the median is somewhere around $1.25 trillion a month, which is a lot. Now let's go to the outlier for March of 2020 at $2.72 trillion, an enormous flood of requests by foreign investors in US Treasuries to sell their treasuries to US dealers. Now remember, all of these sales in essence must be handled by US dealers. The vast amount of that is by US bank affiliated dealers, now subject to much stronger capital requirements and much less interested in taking those positions unless compensated for expanding their balance sheet. And it now requires a lot more compensation. I'm going to skip that slide in the interest of time and talk about the compensation. This chart was prepared by the head of the open market trading desk of the Federal Reserve Bank of New York for a speech in April of this year. It's the bid-offer spread in the customer to dealer segment of the treasury market. So if you're an investor and you want to sell treasuries, the bid-offer spread that you faced is illustrated in this figure, and it's indexed to 100 at the beginning of the year. And you can see that bid-offer spreads were relatively stable, and then on the COVID news, they spiked by more than a factor of 10 times. So investors were basically getting the message from the large bank affiliated dealers, yes, we will handle your trades, but our balance sheets are stuffed. In order to, the shadow cost of expanding our balance sheet more for an additional trade has gotten very high, and the bid offer spreads became enormous. By the way, this did not happen because the dealers stopped intermediating the market. In fact, the amount of trade increased. The dealers did offer a significant amount of dealer balance sheet space, roughly double the normal volume, and they made a lot of money. So it wasn't that they were withdrawing from the market, it's just that their balance sheets got stuffed. This is in the interdealer market that I illustrated earlier, the depth of the market. So let's take New York, for example. In the interdealer market, if you look at the amount available for trade at the best 3 bids or at the best 3 offers on the central limit order book at BrokerTec, that was around $175 million leading up to the COVID pandemic news. Then on that news, with the flood of demands for liquidity, the amount offered at the best 3 bids or the best 3 offers plummeted from around 175 million to under 10 million. So basically no depth in the market. The dealers were simply not interested in absorbing larger positions. The principal trading firms continued to offer liquidity, but their fraction of trade at BrokerTec shrank. These are the volumes that I spoke about earlier. So as I said, well, let's just look at total trade volume in billions. And this is week by week because that's how it's reported. There are actually 2 time series available. I'll explain that in a moment. The green time series is as reported by US primary dealers. How much trade did they handle? So as I said, when March came along, they got enormous requests for trade and they accommodated a lot of that, but there was such a large amount of requests for trade, they eventually got stuffed. And then with the Fed's rescue of the market, trade volumes came back to normal. Bid offer spreads returned more or less to normal. It took some time in the longer dated treasuries, and the market returned to normal. I do want to point out that beginning just by chance, beginning in the March of this year, we have TRACE data for US Treasuries on aggregate volumes. TRACE, as you know, for those of you that study the corporate bond market, provides transaction by transaction data in the corporate bond market with prices and quantities. But in the US Treasury market, we don't have any transaction level data. The official sector does, but FINRA has yet to release any of those transaction level data to anyone outside the official sector. You can see that the FINRA volumes more or less track the primary dealer volumes. They're not exactly the same because the green bars for primary dealer reported volumes are firm reported and they involve some double counting. You can also see from the TRACE data that about half the volume is between dealers and customers, and about the other half is roughly is in the interdealer market. That's the interdealer market is in blue. ATS stands for Automatic Trading System. That's roughly BrokerTec and eSpeed. I'm worried that I'm speaking too quickly. I'm not hearing any questions, so I'm going to go ahead.
Yeah, go ahead. Go ahead. You are fine.
Good. Thanks so much, Hossein. How am I doing for time, by the way? How many more minutes will I have before we should go to Q&A?
Yeah, you have about 25 minutes, close to 30 minutes. So you're good.
Good. Excellent. Because I want to continue to emphasize what we're learning from March. I mean, not only was it an event of dysfunction that was problematic for US financial stability and for price volatility for investors, it taught us a lesson about market structure, which I'm going to get to. This diagram illustrates the amount of treasury positions financed by the major dealers. So the dealers had to provide a lot more financing in March because they were basically, they had a lot, their balance sheets were stuffed and they needed financing for all of that. Every time they add financing positions, they also increase their balance sheet size, which also requires additional regulatory capital, not to mention placing demand on liquidity in the repo market. And the repo market was also somewhat dysfunctional for a few days, but it returned to functionality when the Fed swooped in and provided unlimited financing of treasuries to primary dealers. So financing was not so much a problem with respect to availability, but it was a problem with respect to the amount of space available on balance sheets. At some point near the end, well, actually on April the 1st, the Fed said, we are eliminating from capital requirement called supplementary leverage ratio, any capital requirements associated with reserves, which are the cash side of repos, and US Treasuries. They did not, by the way, eliminate the capital requirement for repos themselves. What I want to do is spend some time discussing what this tells us about market structure that can be addressed going forward. If anyone's interested, there's a paper available either through the Brookings Institution or on my webpage that discusses all of this in much more detail. But I'm gonna slow down and try to motivate very carefully what I think the official sector, meaning the Treasury Department, the CFTC, the SEC, and the Fed should together study as a possible way to resolve this problem of market dysfunctionality when trade demands surge. And it starts with central clearing. So first, let me describe how central clearing works currently, and then how I would propose the official sector studies and expansion of central clearing so as to address this problem. First, in the customer to dealer market, if a customer buys or sells from a dealer, that trade is bilaterally settled. So if customer one, that could be Hossein, calls me at JP Morgan for a bilateral trade, we are each responsible to each other for settling that trade. It's typically tomorrow, one day lag settlement, although there can be settlement delays, which I'll talk about later. In the interdealer market, if I trade instead with Sanjay, if we do it on BrokerTech, we will typically novate our trades to a central counterparty called the Fixed Income Clearing Corporation. And that Fixed Income Clearing Corporation says, you don't need to wait till tomorrow to settle, to know that your trade is going to be settled. We are committing today that your trade will be settled. And that's quite valuable, both in terms of the stability. We don't need to worry about performance with each other. We know our trades are now guaranteed by FICC, which has a lot of resources. It's also valuable with respect to how much balance sheet space is needed to intermediate the market. Let me explain that. So if I bought 100 billion of the treasuries from Sanjay, and I sold 80 billion of the treasuries to, let's say, Nikunj, that means if I don't centrally clear, I have a gross settlement amount to handle of 180 billion. That's 100 long, 80 short. That is a big commitment of balance sheet space. If, however, Sanjay and I novate our trade to the CCP, and Nikunj and I novate our trade to the CCP, well, now my commitment is to buy a net of only 20. So 100 minus 80 is 20, and I'll pay for those tomorrow at the CCP. So my commitment went down in this example by a factor of 9. This kind of idea of compressing network commitments by novating to a central counterparty is responsible in the swap market for an enormous reduction in balance sheet space among the dealers, achieving a much better market structure and improvements in liquidity in that market. Because balance sheet space is not used as much. Currently in the US Treasury market, however, of all trades, only about 22% of those transactions, if you're on one side of those transactions, only in about 22% of cases is your trade going to be centrally cleared. The other 78% not centrally cleared, which means all of that netting down that I just described is not being exploited. Moreover, there's a lot of settlement risk. And there have been government reports and a report by the Treasury Market Practices Group, which is cited on this slide, that outlines the degree to which we should be concerned about settlement risk and counterparty risk in this market. So it's not only a question of balance sheet efficiency, it's a question of financial stability on the settlement risk side. There have been proposals in the private sector and in government reports to consider a broader central clearing arrangement. I want to go through that now and why I think this is not only important for counterparty risk and settlement and financial safety in the Treasury market, it's also important to make the market better able to handle surges of trade demand. So what I have proposed in my Brookings paper is that the official sector considers imposing a broad central clearing mandate, which would mean, as was done in the Dodd-Frank Act for swaps, all major market participants, with minor exceptions, would be required to have their trades novated to a central counterparty. So for example, in the US swap market, the fraction of swaps that are centrally cleared has gone from about 10% to more than 90% since the financial crisis. In the Treasury market, a similar increase in central clearing would result in more safety because more transactions would be centrally guaranteed. And it would free up a lot of dealer balance sheet space, because now when I buy from Hossein and I sell to another market participant, maybe Farshid, I can net those two trades off of my balance sheet into the CCP. And this has already achieved a measure of improved efficiency in the repo market through a technique called sponsored repo, where essentially that same netting that I described has been achieved in the repo market for some fraction of repo market transactions. What I'm proposing that the official sector mandates, or at least analyzes the cost benefit of a mandate, is that all major market participants would use a central counterparty for both their repo trades and for their cash market trades. And those functions are both being done at the Fixed Income Clearing Corporation already. So it would be an expansion, not in terms of the types of transactions, but in terms of the set of market participants that would centrally clear. And again, two major benefits from that: financial stability, that is less settlement risk, and this is going to be very important as the treasury market gets bigger and bigger, and freeing up dealer balance sheet through the effect of netting, so that the next time there's a surge of trade demands, the pipeline of dealer balance sheet space that's tied up between the time at which investors attempt to sell and the times at which a final the final position is obtained by the ultimate buyer is reduced and netted down. So that's, I think, very important. Now let me talk about the third benefit of central clearing, which is in the current market structure, as I mentioned at the beginning of my remarks, it's impossible for the blue dots to trade directly with each other. The market is set up as a dealer-based market where, in order to buy or sell, any of the blue dots need to go through the dealers. And the position needs to be purchased by a dealer and then sold by a dealer. In order to do all-to-all trade, let's say on an electronic exchange, it would be important to have a central counterparty. It's a prerequisite for all-to-all trade. It's a prerequisite in the sense that you need it for straight-through processing of electronic trades, and you also need it for anonymity. If there were a central counterparty, it's not a guarantee that all-to-all trade would happen, but it would at least allow for that possibility. And an exchange could set up a business, a new trade platform, or an existing trade platform like BrokerTech could say, wow, now we have central clearing for all major market participants. We can benefit by offering them trading services. They can post in bids and offers and trade directly on the central limit order book. If the treasury is an off the run that's less frequently traded and there's not enough trade activity to justify a central limit order book, then we can use a technique called all-to-all request for quote, or RFQ. All-to-all RFQ is already being used in the corporate bond market, and it's still small but growing rapidly in the corporate bond market. It doesn't exist yet in the treasury market to any great extent. So let me summarize where we are so far. First, COVID news caused a surge of demand for liquidity in the treasury market. Second, the dealer intermediated market was not able to handle the surge of demands for liquidity because balance sheet space was too limited through improvements in financial regulation. Third, that problem can be mitigated to a significant degree with central clearing, and central clearing opens up the possibility for more all-to-all trade, which means dealer balance sheet space is not needed for every single trade. The blue dots can reach each other without traveling through a green dot. When I proposed this idea, I got some requests for clarification of whether the transactions demands in the treasury market are so large that they could not be centrally cleared. And I decided to prepare this slide to show that, in fact, even larger amounts of transactions in terms of risk flows are already being centrally cleared in the equities market. So on the vertical axis in this diagram is the total amount of one-day settlement risk in blue of the SPDR S&P 500 contract, which is an ETF, contract, which is cleared at the NSCC, the National Securities Clearing Corporation. And in red, the total amount of one-day settlement risk in a US Treasury note, in the 10-year US Treasury note, which is the largest amount of risk flow in any single Treasury note. And you can see the blue is a lot bigger than the red. In fact, this is conservative because equities are 2-day settlement, Treasuries are only 1-day settlement. So the amount of settlement risk handled already in the equities market is bigger than that in any single Treasury note. And it's being centrally cleared without difficulty. And I think we can all agree the US equity market did not become dysfunctional on the pandemic news because it's a centrally cleared, mostly all-to-all market. What about settlement failures? And this will be my, Hossein, this will be my last demonstrative, and then we can go to Q&A.
Sure.
So in the Treasury market, when I buy from Hossein, he's committed to deliver tomorrow. But when tomorrow rolls around, there's an arrangement in the market by which Hossein can call me or message me and say, sorry, I'm going to fail today. So I'll pay you, I'll give you the securities tomorrow. And I don't have much recourse. The only recourse I have is that I don't have to pay him today. And so I don't have to finance the position, but I'm going to get it tomorrow. And those settlement failures are normally on the order of around $100 billion a week. As you can see in this diagram, I've got 2 time series for fails. One are failures of trades that were centrally cleared, and the other is failures of trades that were handled by primary dealers. The amount of failures soared in mid-March, exactly when the market became dysfunctional in terms of trading. So what happened? Promises were made to deliver securities that were not met because it was difficult to get the securities through the dealer balance sheets and onto the ultimate buyers sufficiently rapidly relative to the amount of trades that were being executed. When settlement failures soar, there's a daisy chain problem. So if Hossein doesn't deliver the securities to me, and I had promised to deliver them to Sanjay on the same day, then I'm going to end up calling Sanjay and say, sorry, I can't deliver your treasuries as planned. This is a fail. And then Sanjay could fail to Nikunj and so on. So when you don't have central clearing, you can have a daisy chain of failures. And that's what happened. Now I can't, without the transactions data, which I'm still hoping that the FINRA trace data will eventually address this with data by filling that data gap. But without the transaction level data, I can't tell you how much of the fails were caused by what kind of mechanism. But as you can see, the centrally cleared trades did fail more, but not as much more as all trades did. So I think central clearing, because it breaks those daisy chains, will reduce the degree to which settlement failures occur in the Treasury market, which will also improve safety. Because the longer I go without delivering those securities to Sanjay, the more worried he's getting that I won't be able to make good because the Treasury prices have changed in the meantime. So settlement fails are a source of counterparty risk that I believe can be mitigated by central clearing. And the more, I think one can show mathematically that the more the trades are centrally cleared, the lower will be the amount of settlement failures. It's simply because the length of the daisy chains is cut down. Okay, I'm going to stop there, Hossein, and
thank you so much.
what questions you may have.
Sure. We have a few questions. I have a couple of questions on my own. Actually, let me start with my own, which is, I was quite surprised by how large the spreads became. I mean, I knew something, we all heard about something happening in the market, but the spreads, tenfolds, that was unbelievable. The other thing is that I saw another chart that showed it took almost a month for the spreads get back to normal. Why did it take so long? I mean, you would think with all the Fed action would have gone down immediately.
Well, there was a giant backlog of demands for liquidity. So as the Fed was removing treasuries from the market, sellers of treasuries were continuing to stuff the balance sheets of the dealers. So the Fed was buying 60 to 70 billion a day. I mean, that's unheard of. And still, the amount of treasuries that that were flooding the balance sheets of the dealers was very high. Eventually, it went down. So the Fed was doing the right thing. By the way, it wasn't just bid-offer spread. All of the indicators that I showed you took between 4 and 8 weeks to come mostly back to normal. But even in midsummer, the 30-year bonds were showing persistent signs of illiquidity, pretty much cured by now. The Fed did a great job. By the way, I should mention, it is the proper function of the central bank to come in and rescue the market. And it has done it before. It did it on the eve of the Second World War. In September 1939, the US Treasury market became dysfunctional. And the Fed swooped in, rescued the market. It did it again in 1970 on news that the US had invaded Cambodia from Vietnam, and there was a tragic protest at Kent State University, and the Treasury market went dysfunctional, and the Fed stepped in again and returned it to liquidity. So this is the third or fourth time in the last century, and my concern is going forward, it's going to get more frequent. You saw my chart showing the degree to which the blue bars are overwhelming the red bars.
We have a question from the audience, and the question is that there are many types of treasury securities that Treasury basically issues, economizing on the types and having fewer type of kind of Treasury debt. Would that help, or probably not much of an effect?
Actually, John Cochrane made a very radical proposal on that line several years ago. And I think it would help in terms of improving netting ability, because the number of different CUSIPs that have to be matched between buyers and sellers would go down. So there would be a more rapid flow through that pipeline of dealer balance sheet space. But I honestly don't think the debt management office at the Treasury wants to cure this problem by reducing the number of, I mean, it could at the margin reduce more. It could do the Japanese model of having a benchmark that remains a benchmark for 5 years or more, and just keep reissuing the same CUSIP over and over again. Mm-hmm. And that's one of the things that Japan has done to mitigate this problem. The US is a much more bond-centric market. Investors want treasuries of a specific maturity to hedge corporates, and they have ladder-based investment strategies. You know, some of us are probably in target annuity funds that use a ladder of treasuries. So I think it probably, if it's only to cure a liquidity problem, then I think this is not the best solution, but it would mitigate it.
Thank you. Another question from the audience is that it says, by injecting cash and offering liquidity, of course, we reduce rates, but especially we punish the long-term bond investors because then going forward, they're going to be reluctant to hold long-term bonds because it's almost close to the zero. So are we creating sort of a liquidity trap for long-term investors similar to Japan and Europe or not?
Yeah. Well, okay, so that is a fantastic question. I think it's somewhat orthogonal to the question of market liquidity. So basically, if the Fed, not for market liquidity reasons, but for quantitative easing purposes, decides to cap the yields of treasuries at a low level, then there will be an issue of, what does that do to demand and supply for treasuries, to expectations of market interest rates, to incentives for saving. There is this reversal effect, which Marcus Brunemeyer has written about, by which if yields are too low, then banks can't make money, they become weak. Or if yields are too low, then rather than reducing the incentives to save because you get a low interest rate on your savings, you could actually increase the incentive to save, because if you're saving for retirement and you need whatever, $200,000 at retirement, now you have to save a lot more in order to get that much at retirement at a low interest rate. So it's a great question, although I think it's a separate question than the one of market functionality.
Mm-hmm. Another question from the audience is the capital requirements. I think you mentioned that capital requirements to some extent have constrained the balance sheet. But you didn't touch upon that particular part, but you think that the Fed needs to relax that to some extent, or the Treasury?
So it was proposed by the Bank Policy Institute that capital requirements did reduce the incentive of dealers to expand their balance sheets to absorb the flows. And I think that's exactly right. Now the question is, do you want to relax the capital requirements? And what would be the consequence? I think if you relax the capital requirements, the market would get a lot more liquid, but I think it would be a bad idea because we would go back to a world in which we can't rely on banks as a source of safety. Instead, they are exacerbating, amplifying a financial crisis as they did in 2008. So rather than going through the relaxed capital requirement route, I would tend to go more through the market structure, improve the market structure as I suggested.
Mm-hmm. Another question from the audience. Any other country using the CCP structure or something similar to that? The one you're proposing?
Well, there is more central clearing in Europe. There's Euroclear that handles a larger fraction of government securities transactions in Europe with respect to central clearing than is done in the US. Mm-hmm. And there's also more or closer to all-to-all trade in Europe with MTS, which is a broker tech platform in Italy. But the Europeans also had problems and not as bad as the US Treasury market. And they don't have a central clearing broad mandate, and they don't have broad all-to-all trade. For example, on MTS, the buy side can participate by taking quotes, but they are not allowed to participate by offering quotes. Mm. So they can't provide liquidity to the market, they can take liquidity from the market. So you can see that there's going to be winners and losers with all-to-all trade. The dealers who are currently intermediating 100% essentially of investor trade would lose some of the intermediation rents. And so that would be an unfortunate loss for them. But other than for the dealers, I think it's a win-win to go to all-to-all trade. Safer and lower cost for trade in general, more competitive, more opportunities for other investors to contribute to the provision of liquidity.
Mm-hmm. I have a sort of a meta question or broad question. And I read about this, I guess, in headlines that this basically kind of weakens, or at least the prospect of US remaining the dominant currency around the world. And maybe there is a need for a more diversified portfolio of global currencies. What do you think of that? I mean, if the size is becoming too big for the market to handle, basically. Yeah.
Well, a lot has been written about that. I would recommend reading the work of Pierre-Olivier Goranchat at Berkeley. And I agree with some of his work that suggests that the US reserve currency status is going to be here for some time. It is, as I mentioned earlier, resting heavily on the depth of the US Treasury market and the price discovery offered by that market. So if the Treasury market were to become dysfunctional on a more normal basis or a more frequent basis, then the reserve currency status of the dollar would be less strong, but I think it's not going to get replaced by anything very rapidly. The euro has lost actually some of the gains that it had up until 2015, or actually start up until 2011. From 2011, the euro lost some degree of reserve currency status. The renminbi, which would be the next large player on the scene, is still, while it's improving in the internationalization of the RMB, it's still nowhere near a reserve currency status. It's used for a small fraction of payments and settlements internationally. And there's as everyone knows, limits on capital flows out of China, which makes it harder to use the renminbi as a reserve currency.
All right.
Question, Hussein?
Go ahead.
Yeah. So my question is, the Fed tightening that you talked about, when the Fed is buying all the bonds and the rates are getting lower and lower, the Fed loosening. So what is the benchmark for that? We can always say if it goes too low, then it's not good, but it is already too low, right? I mean, what's the benchmark? What benchmark are you using historically from last 300, 400 years? We're already at a very, very low level, right? So how do you say when it is too much?
Okay, so again, I want to separate I'm going to answer the question, but I want to separate first what happened in March with the Fed buying. It wasn't about getting yields down. was about taking bonds out of the hands of intermediaries so that they were able to intermediate the market. But it did have a side effect of keeping yields lower. And in general, the Fed has indulged in lots of quantitative easing in the last decade, coming out of the last financial crisis. If you stand back and look at a chart of global 10-year yields from all major currencies, going back from about mid-1980s, it's just down, down, down. It's almost like it's like a ramp heading into the ocean. And I think it's not. I mean, it's been diagnosed a number of ways. Demographics, we have a much larger age distribution with a lot of the wealth concentrated towards people retiring. So storing money in bonds is driving down yields. Productivity is not growing like it did. And government deficits, you would think that would cause yields to go up, because surely we're going to use inflation to get out of all this deficit problem, but it's had the opposite effect of causing central banks to try to stimulate their economies by lowering interest rates. So it's a giant downward pressure on yields.
So who was this seller that came in March? Like, was there a panicked foreign seller who sold? Who do we know who that was?
That is so interesting. So interesting, Sanjay. There's been a buzz of emails. I must have had 10 a day for the last several weeks about people wondering, where were these demands for liquidity coming from? Was it foreign central banks? And if so, why? Was it hedge funds doing risk parity? Was it hedge funds doing the cash futures basis trade? Or was it just everybody looking for safety by converting their relatively liquid positions, treasuries were still relatively liquid, into cash in order to meet margin requirements and other demands for cash? Very, very hard to tell. And it's ironic that we don't really have the trace data necessary to analyze that. I don't think the government has all the data it needs. And that came up in a conference that I was in on Tuesday with Vice Chair Quarles. And definitely academics don't have it. On Tuesday, during my conversation with Vice Chair Quarles, I likened it to the situation with the Dead Sea Scrolls. I don't know if you know the story of the Dead Sea Scrolls, which is basically that in the first half of the 20th century, this massive trove of Dead Sea Scrolls was discovered in an area of Jordan. The research institute that was lucky enough to get these Dead Sea Scrolls decided, wow, this is a wonderful data for our scholars to study. And they didn't release those data to any other scholars for decades. Then, ironically, in the 1967 war, Israel got control of the same location, and its research institute then sat on the Dead Sea Scrolls and prevented scholars from getting at them for another 30 years. So really, those that have the data need to share the data so that scholars can study what happened. And I think that's definitely true of the Treasury transactions data. And it's been on the agenda for some years now.
Chester, I think once has a question. Chester, you're on mute.
Thank you. Hi, Darrell. I enjoyed your presentation. So I actually have a two-part question. Should we be concerned that by saving the markets, which I'm sure was necessary, the markets were completely dysfunctional in March, that the Fed also bailed out hedge funds and discouraged market discipline in the future? That's sort of the first part of my question. And the second part, sort of separately, but related. I agree with you completely about reducing the special role of the primary dealers, as in your CCP proposal. But should we be concerned that having safer institutions won't be that helpful net, because financial institutions will respond with more risk-taking and systemic risk will largely kind of undoing much of the benefit?
Okay, those are fantastic questions, Chester. Let me address them first one first. I totally agree on the moral hazard of relying on the central bank to come in and rescue you, because it just encourages risk-taking. It says basically, I don't need to get out of my positions in a stress period. I can just wait. The Fed will eventually rescue me. And that just causes buildups of risk. And I talk about that as what we should not do is just rely on the Fed and allow a fragile market design to continue when we have the opportunity to fix the market design and reduce the frequency with which the Fed needs to step in. Now, of course, there's still going to be, I mentioned 3 cases in the last century. There are still going to be cases where the Fed needs to step in, but we shouldn't have it a norm that everyone is expecting, and which causes this moral hazard and risk buildup. On the second point, trigger me again on the second point. It was
it's sort of about system to basically reduce the special role of the dealers with the with your CCP proposal, and whether that would kind of undo a lot of the benefits by encouraging institutions to take on more more risk, sort of endogeneity of the systemic risk.
So I think it would actually have the opposite effect, and here's why. When you have a central counterparty, it needs to set uniform, transparent margin requirements, and both initial margin and variation margin, and it has to have committed funding. What that means is that market participants that were kind of in the shadows, whose positions were not known by anybody and still not known by anybody, and were under whatever margin arrangements that their counterparties decided was okay, gets replaced with a situation in which everybody is subject to strong minimum margin requirements, and their positions are known, they're in the daylight. So I think it actually makes the system much safer. And that's not even counting the reduction in counterparty risk, because it's not a situation in which you take the same amount of risk and you just put it in a new place. You actually lower the risk substantially through netting. So go back to my example with Sanjay and Hossein. I had 100 billion commitment on one side, 80 billion on the other. That 180 billion at risk gets converted to only 20 billion at risk. So it lowers the amount of risk in the system on top of providing transparency and uniform standards for leverage. So I think it's a big improvement. It creates some substitute for a shadow trading world, some substitute for regulation. But you and I can talk about it later, Chester, if you want to.
Yeah, no, perhaps we should. But those are really terrific answers. Thanks, Darrell.
Hi, Darrell. This is Mila Sherman. How are you?
Good. So nice to speak with you, Mila.
Yes, likewise. Thanks a lot for presenting. And so the question is about kind of, I assume that this proposed CCP will still have loss sharing agreements, right? So in this case, will these blue and green dots be treated the same? So specifically, as we know, in loss sharing agreements currently, margins are proportional to net and not gross exposures, which will favor dealers because they usually tend to have net zero positions, which are green circles compared to the blue dots, right? Which probably will have either net positive or net negative exposure. So this potentially might lead to reluctance of blue dots to clear because they will have to pay higher margins due to the loss sharing agreement. So what do you think about this and how can we rectify this? So there's, similar interest in clearing and not reluctance to clear from the blue dots.
Right. So it's a great question. So let's talk about the green dots versus the blue dots. The green dots, you're right. They are in a beneficial position of both buying and selling. So their commitments to the CCPs will be lower per unit of gross trade than the blue dots, who are typically trading in one direction only. And because of that, the blue dots have higher commitments of whatever that form of commitment is to the central counterparty per unit of trade than the green dots. But that's kind of the norm in a market where there are intermediaries. That's a typical situation that intermediaries are both buying and selling, profiting on the bid-offer spread, and netting their trades down. So, but it is true, that the blue dots will have to supply margin. And it's kind of related to my answer to Chester's question. They are already supplying margin to the extent that they would at the CCP unless they're not supplying enough margin relative to their positions. So what happens is we put uniform standards on their margin requirements. If those standards are right, they're supplying the right amount of margin and it's the same amount that they would have supplied in a bilateral market. It's the green dots that are going to benefit more from central clearing. And why, you might ask, haven't the green dots, who are really arranging the market design more than the blue dots, why haven't they done this already? Well, because once you have central clearing, in my view, it's easier to have exchange trading. And if I were a major dealer and working on behalf of my shareholders, I would say, well, why should I set up a market design that penalizes my shareholders we will benefit from a lower fraction of trade intermediation and probably narrower bid-offer spread, so it's not good for me. So this is an area in which I think the official sector probably needs to mandate central clearing, and it will be costly in terms of committed liquidity to the central counterparty. Will it be more costly than the existing world? Not if the standards are the same. It'll be less costly in total.
Thank you. Thanks a lot.
Well, thank you so much, Darrell. I think we have a couple of more, but for the shortage of time, we have to postpone them. But you can probably see them yourself. So again, thank you so much for sharing your thoughts on something very relevant and important, and a very good policy discussion followed too. So.